Good evening, everyone. Thank you for joining this evening Corporate Connect featuring Lendlease Global Commercial REIT, as well as our audience from Facebook Live. This webinar is organized by SIAS and supported by SGX. We will kick off tonight's webinar with a presentation by Mr. Geoff Howie, market strategist from SGX on recent market highlights, followed by the corporate presentation by Mr. Kelvin Chow, CEO, and end off with a Q&A session. Lendlease Global Commercial REIT is established with the principal investment strategy of investing directly or indirectly in a diversified portfolio of stabilized income-producing real estate assets located globally, which are used primarily for retail and office purposes. In Singapore, its portfolio comprises 2 leasehold interests in 2 retail malls, namely GEM and 313 at Somerset, as well as freehold interests in 3 Grade A offices, Sky Complex in Milan. Without further ado, can I invite Mr. Geoff Howie to present, please? Over to you.
Thanks, Eileen. Let me just share the screen, please. And we're away. Good evening. Thanks, Eileen. My name is Geoff Howie. I'm market strategist at SGX. And I forgot to put my disclaimer slide in. So just a very quick disclaimer. This is going to be completely educational material. Please don't take anything that we say as being advisory, and we basically all we're attempting to do is spend 15 minutes or so just to provide a quick overview of what's been happening in the Singapore REIT market to kick off just before Lendlease. So as we know, the STI has been among the stronger developed markets so far this year. Banks have been a big part of that. Having less tech exposure in the STI has also been a big part of that. But also REITs make up the second biggest sector of the Straits Times Index with an approximate 13% weight. And interesting, since July 2002, 20 years ago, Singapore has actually grown to be one of Asia's largest REIT and property trust markets. So far this year, global reopening, regional reopening in particular, has been an overarching theme that's impacted this sector for the first half of the year. And the sector has continued to attract, I guess, more than its fair share of investor activity, with the sector representing more than 10% of the total market capitalization now of the Singapore stock market, and in fact makes up more than 20% of the day-to-day turnover. And that 10% day-to-day, that 10% contribution to total market capitalization or market value, it is comparatively high. For some global perspective, you have around $2 trillion of market value of REITs listed all across the world, and that represents just 2% of the total market value of the global stock market, which is around $100 trillion. The largest REIT in the world has a $100 billion market cap. That's America Tower Corp. It doesn't actually rank among the top 100 stocks by market value, but it owns and operates those wireless communication broadcast towers in the United States. REITs have been in the US since the 1960s, and they make up just a quarter of the 800 or so REITs traded across the world, but they do make up 60 to 70% of the combined $2 trillion value of global REITs listed across the world. So in Singapore, we also have this big global type of prism for our REIT market. A very, very globalized market, a lot of global reach. As many as 17 of the trusts exclusively invest in property assets outside of Singapore, with 20 of the trusts investing in Singapore and outside of Singapore, and the remaining 3 REITs investing exclusively in Singapore. And this includes as many as 10 trusts with properties in China, as many as 8 REITs with properties in Japan, and 6 REITs with properties in Malaysia. So with 80% of the trusts owning and managing overseas assets from across Asia Pacific, the United States and Europe, S-REITs are now, as we said, one of the most global REIT markets. The trusts are also highly diversified across property types, with a balance across retail, industrial, office, and hospitality properties, in addition to multiple REITs investing in healthcare-related properties and specialized REITs such as data centers. So the FTSE ST REIT index, which includes some 35 of the 40 relevant trusts listed for trading in Singapore, has generated close to a 115% total return over the 10 years ending 30th of June, which has outpaced the STI. Clearly, the diversity of the REIT sector has been a strength of the sector, which has been varied. We've seen varied performances across the different subsegments of either type of properties that make up the REIT portfolio. So you've seen these very performances across segments, and that's more so because of the big global forces that have been driving much of the stock market and the uneven economic recovery and performances. And that's been an overarching theme with COVID-19, more so than where the different economies and the different economic pace that these subsectors have been seeing. For case in point is for the first half of this year, hospitality-related REITs really led the sector versus data center REITs, which led in 2020 on work from home demand for streaming, for 5G, for cloud services, while you had the resilient regional global trade and manufacturing providing support for industrial REITs. So all pure play hospitality REITs with Singapore assets, Ascot Residence Trust, CDL Hospitality Trust, Far East Hospitality Trust, and Fraser's Hospitality Trust, when you look at those REITs, if you look at the trio of Ascot Residence, Far East, and CDL Hospitality, they've averaged 15% total returns in the year to date, with most of the hospitality trusts with Singapore assets reporting that higher revenue per available room, the RevPAR, and that was due to growth in their average daily rates and the occupancy for those hospitality assets. And they also expressed optimism for 2022 in their results as they see recovery and reopening across their operating markets. Fraser Hospitality Trust, which is subject to a proposed privatisation, has generated a 4% total return this year, and it did note at the end of July that Europe still leads the international travel recovery as APAC actually trails behind, which was in their end of July report for the first half of this year. I should also mention that combined market value of the S-REIT sector, it has grown at a 13% compound annual growth rate over the past 10 years. It's not just down to performance, but portfolio growth through acquisitions that, among other methods, which include debt, can of course be funded through rights issues and placements. Proactive capital management has also been a key trait of the S-REIT sector since its inception. There's been a clear industry drive to increase unit holder value, to divest, to recycle, or to acquire properties. And we saw close to half of the S-REITs listed on SGX announce asset acquisitions valued at more than 12 billion Sing dollars in total purchase consideration last year, with that acquisition drive continuing in the first half of this year with the likes of Cromwell European REIT, CDL Hospitality Trust, Mapletree Logistics, Lendlease Global Commercial REIT, Ascot Residence Trust, and CapitaLand Integrated Commercial Trust as well, announcing acquisitions in the first half. It was in April that Lendlease Global Commercial Trust Management completed its acquisition of the 100% direct interest in GEM. The manager maintained that the enlarging portfolio with tenants, which then those tenants will be detailed in the next presentation, would provide robust cash flows for the unit holders. And with the acquisition, Lendlease Global Commercial REIT's portfolio weighted average lease expiry increased to 8.7 years. So weighted average lease expiry, it's a key metric used by the industry to measure the tenancy risk of a property. So it takes into account the tenant's area or income, and importantly, remaining leasing years, which is then weighed to the total combined area or the total income of the tenants. And it's a pretty simple formula. So for a simple example, assume a REIT has just two tenants. Tenant one occupies 40% of the rental area, and it has its lease expiring in 3 years, while tenant two has the remaining 60% of the rental area, and its lease expires longer in 6 years. So the weighted average lease expiry would just be 0.4 times 3 years for tenant 1, and then 0.6 times 6 years for tenant 2, which would be 1.2 years for tenant 1, 3.6 years for tenant 2, a weighted average lease expiry of 4.8 years. So that's just a quick, basically to understand where that metric comes from. But acquisitions, they did continue also in July. We saw Ascendus India Trust propose the forward purchase acquisition of 2 industrial facilities in Chennai under their phase 2 project in the Mahindra World City. So I'll move along as quick as I can. At the end of June, the average distribution yield of the listed REITs and property trusts stood at 6.6%. That trumps the STI yield of 3.9%, and the Monetary Authority Singapore benchmark 10-year bond yield at the end of June, I should say, was at 3%, with core inflation at 3.4%. Looking at comparing this to where yields are, there has been this backdrop of increasing rates at a faster pace than expected. Singapore government security yields had increased 120 basis points in the first half of the year, but the FTSE ST REIT index was still offering a higher yield spread of around 260 basis points. Furthermore, the REIT sector appears to have controlled debt levels. The average gearing ratio, which is simply total debt over total assets, was around 37%, lower than the regulatory limit of 50%. And the sector has also, on average, secured 75% of their borrowings on fixed rates. And according to Beansprout, which is an independent research firm, Singapore's REIT benchmark generated positive returns in previous episodes of interest rate increases. 26% total return between June 2004 and to 2006, and then a 12% total return from December 15 to December 2016. The highest yielding subsegment at the end of June was office REITs and retail REITs. Within the office subsegment, I think it was its Prime US REIT maintained a yield of 9.8% actually at the end of July. Manulife US REIT maintained a 9% yield. Keppel Pacific Oak US REIT maintained an 8.8%, and Elite Commercial REIT maintained an 8.7% yield. So within the retail segment, there were also 3 REITs that had yields among the top 10 yields of the REIT sector. And in fact, there were 7 of the 10 highest yielding S-REITs as of the end of July represented either office REITs or retail REITs. Now, interesting that, I guess, prior to COVID, industrial REITs typically did maintain the highest yields in the sector, and Singapore lists 8 industrial S-REITs. I think 6 have exposure to Singapore-based assets, the likes of Ames APAC REIT, Ascendus REIT, ESR, Logos REIT, Mapletree Industrial REIT, it's Mapletree Logistics Trust as well. Mapletree Industrial Trust and Mapletree Logistics Trust, as well as Sabana Industrial REIT. And then you've got Daiwa House Logistics Trust and EC World REIT, which are based in Japan and China, respectively. Now, why I'm just mentioning that big point, because as we said before, the sub-segment of the REITs had a pretty big impact on their performance over the last few years, because industrial REITs, they were comparatively defensive from the end of 2019 right through to the end of 2021. When global trade continued to be resilient and outpaced global growth in both 2020 and 2021, you saw that resilient manufacturing for those full 2 years supporting APAC industrial REITs. So of all the Asia Pacific listed REITs that had industrial parks, warehouses and depots and so forth, they actually averaged 28% total returns for those full 2 years versus a 4% decline in total return for all of the remaining APAC REITs. Should mention too, quickly, that on the whole, global REITs, they do have a track record for being defensive in nature. And the 800 or so REITs listed across the globe, they have performed comparatively well in terms of yield and volatility and net asset value over the past 10 years. And that has obviously spanned, as we said, these broader market up and downs, including interest rate cycles. If you take the FTSE ST REIT index or the IHS REIT index, both have delivered higher yields and less volatility when it compares with the STI, the Dow Jones, the Nikkei, or the Hang Seng Index. And the diversified nature of S-REITs, I guess, in terms of subsectors, have played a part in their resilience during the sell down. Industrial, data center, and healthcare asset REITs were the beneficiaries of the challenges in 2020, while hospitality REITs have been among the most defensive performers in the year to date. REITs also provide solutions to portfolio managers that do look to spread risk over different asset classes. Bear with me. And with the FTSE ST REIT index not maintaining any significant correlation to global equities or bonds over the last 10 years, it makes their, I guess, their correlation metrics to all these other indices quite interesting to those portfolio managers that do, as we say, want to reduce their risk and not have too much of a concentrated portfolio. I'll end off now. Just to say thank you quickly. Before I do, I'll just throw up my actual disclaimer. There it is. Just to show you, as I said, this presentation is general information only, and of course all educational. But before, maybe I'll just sum up a bit more nicer before we go into the Lendlease presentation. I guess what really stands out for our REITs, they've been here for 20 years. Investors can take equity in these trusts and participate in the income generated by the tenants of those properties, while at the same time bearing, of course, some of the risk associated with the value of the property assets and the cost of financing the property. So the REIT markets does provide that efficient means to include real estate exposure into your investment portfolio. And as we said, they can include so many different property types now: offices, industrial parks, shopping malls, hotels, and specialized properties such as healthcare and data centers, which have moved, as we said, quite differently over the recent years. They have also been a diverse, or they also have a very diverse base of investors, ranging from institutional, private wealth and retail, and having that average distribution yield for the sector at 6.6% means that they have been, I guess, in demand over those last 10 years for those more income-focused investors. ESG is a very important topic when it comes to REITs at the moment because of so much, I guess, carbon emissions coming from real estate, and that does make sense when you think about our own individual carbon footprints and the corporate footprints. And also NAREIT has been moving very quickly in working with REITs in the US, and as we said, they make up a very big, large part of the market value of REITs in basically seeing that the REITs can adequately report and reduce those carbon emissions. And of course, we've had the sustainability reporting here since 2016, and I know that there's a few highlights on the ESG front that our next speaker, Kelvin at Lendlease Global Commercial REIT, will be sharing as well. So I'll go and mute myself, Eileen, and I'm looking forward to listening in. Thank you.
Thank you, Geoff. Up next, may I invite Mr. Kelvin Chow, CEO of Lendlease. Over to you, please.
All right. Okay. Good afternoon, good evening, everyone, and thanks for joining this session. I believe SGS has covered well on the REIT sectors and give you confidence that the REIT will continue to grow and continue to deliver the kind of returns that you're looking for if you are invested in the REIT. But if it's not, I think hopefully my presentation will give you more confidence to that. Okay, I will talk through our June result that we have sort of announced recently. And then with that, I will take in some questions from the floors. Okay, let me jump to the key financial highlights. Our distributable income rose 55.6% on the second half of FY 2022. I think this is mainly due to our accretive acquisition of GEM, and also better performer of 313 at Somerset. And also we have a DBU growth of 4.9% year-on-year, which is also due to the larger base of, notwithstanding the larger base of the Lendlease REIT units. Overall, we achieved a yield of 6.1%, and we actually also start to refinance our debt to sustainable financing, which certainly has some benefit for it. To it, I will explain to you later. And our market cap increased to 1.8 times to 1.8 billion over the year. So the key metrics I have shared with you. I will share with you the key credit metrics then in the case. Basically, our gearing ratio is 40%, which is actually quite reasonable among the peers. And our weighted average running cost of debt is 1.69%, which I think is relatively low comparatively. And because of our strong performance of our asset, the interest coverage ratio is about 9.2 times. Next, please. Okay, our deposited properties grew 2.1 times to 3.7 billion over the year. This is mainly due to the GEM acquisitions that we have acquired GEM during the year. And also our valuation gain was 2.5% year-on-year due to the uplift of the market rental and also the market sentiment. We achieved a high occupancy rate of around 99.8%, which is quite consistent for the past few quarters. I think XGX also mentioned about the long WALE, and our WALE is about 8.7 years by NLA and 5.5 years by GRI to ensure long-term cash flow stabilities. I think besides, we'd like to highlight that we have achieved a very strong rental reversion of around 3.6% on a year-on-year basis, and this is due to better kind of market sentiments that we have achieved. Next, please. Okay, basically, as I have shared, this is our second rather full year announcement result and also second half of the financial year. So we are looking at distributions of 2.45 cents for this coming second half of this financial year, and in total 4.85% for the full financial year. So if you look at the chart below the table, you will notice that our distribution has actually increased on a year-on-year basis. Next, please. Okay, basically the total asset has increased due to the acquisitions that we have done, and also the unit holders fund has also increased to 1.8 billion. And we have also increased the number of unit issue due to the enlarged size of the shareholders. And also that means our NAV per unit is at 0.78 cents, 78 cents compared to what we have on last year, June, of 0.81 cents. Next, please. Okay, with the acquisitions, we also increased our borrowing to 1.5 billion compared to what we have on March of around 7.7 billion, and gearing increased to 40%, and but the weighted average debt maturities increased to 2.8 years, and a weighted average running cost of 1.69% per annum. Interest coverage ratio maintained high at around 9.2 times, which gives us a very strong confidence that we will be able to serve our interest with a strong performance of assets. Okay, the debt facilities and maturities profile mainly give you a snapshot of what has been going on with our capital management. Basically, we have hedged around 60% of our debt, and we actually increased our sustainable financing to 62%. I think, as I have said, there's benefit out of that because as we achieve some of these sustainability targets, and it will be able to help us to reduce our interest costs, and the reduce of interest costs will be able to translate to higher distribution to the unit holders. And we basically have natural hedgings to all our euro borrowing with asset exposure, so that there's no fluctuations on the balance sheet. And also we actually forward hedge the income that is coming back from our euro assets for easily 12 to 18 months to make sure that we have a stable kind of cash flow for distribution. So we do a forward hedging on the cash flow coming in that we're going to repatriate back to Singapore. And we also have around 250 million kind of undrawn debt facilities available as at the 8th of August 2022. Next, please. So on the portfolio perspective, basically on the left-hand side chart, you can see that we have a very well staggered kind of expiry in terms of NLA and also for GLI. Basically, it means that at any point of time, the exposure of the cash flow and the risk of the expiry leases will not be too high. So there is we make it very manageable across a few years. And also on the right-hand side, you can see that portfolio occupancy is, as I mentioned, it actually maintained relatively high of around 99.8 to 99.9% for the past few quarters. Next, please. So for the REIT, we have to do a year-end valuations assessment, and based on the assessment, we managed to see an uplift of the valuations on GEM by 2.3%, and for 313 by around 0.5%, and our Sky about 18.4% relatively. So in total, the increase of the valuation is around 2.5%. Next, please. As I mentioned, we have a very healthy kind of occupancy due to the healthy leasing momentum. We continue to have a very strong tenant base, and we always been able to fill up our vacant unit as soon as it becomes vacant, so that in the case to continue to generate cash flow for the unit holders. Next, please. So as to the tenant sales, there's been more sales and also the visitations. If you look at the chart, it's actually quite obvious that we already on the sales number wise, we already exceeding our pre-COVID average. I think easily by 10 to 20%. That means the per square foot sales number of the mall has already better off compared to what we have on the pre-COVID numbers. While the visitation number is still slightly below the pre-COVID line, but I think that is due to some visitors coming back to Singapore and all those things. I think eventually we were able to achieve that. But I think what is more relevant to us is really to achieve the sales number, because the tenant need to achieve the sales number to make sure that their business is still viable. I think for us, it's also to continue to provide a convenient and also relevant place for them to do transactions. I think that is something that we try to achieve, and the sales number will certainly means a lot to them. Next, please. Also, we continue to enjoy strong and stable cash flow because from the office that we have, as you know, we have only a single tenant for our Grade A office building in Singapore, which is at GEM to Ministry of National Development, and lease will be last till 2044. And this is green certifications buildings, which Green Mark Platinum and DCA Universal Design Gold Plus. And also our Milan asset is made up of 3 Grade A office building. It's also fully leased to Sky Italia till 2032. And then for those that don't know who is Sky Italia, basically it is wholly owned by Comcast, which is the world #1 broadcasting company by revenue so far. So in the case, it's a very strong tenant also. And there's also an annual rental review based on the CPI index, and the recent increase of the CPI index is about 5.8%. So in the case, we have a very decent kind of increase on the rental on a year-on-year basis. So this is also a green certified certification building, and it's LEED Gold certification in one of our 3 office building in Milan. Next, please. We continue to set targets for FY 2022, and this is some of the things that we have achieved. We achieved 12% reduction in energies and GHG emission. We have 22% reduction in water, and we managed to have 10% recycle rate on our waste. And we adopt the climate related risk assessment, which is the TCFD recommendation for this coming financial year reporting. So that is that's when I think the unit holders were able to actually take reference to what we have in terms of our performance on the climate related risk assessments. And we continue for the past few years to be the top leaders in GRESB ranking. I think we are top in Asia for listed entities, and also we are second in the global perspective on the listed entities category. So that means our asset is very green, and we are able to manage our ESG relevance criteria very well from the perspective. And we continue to create shared values and also social values to the community at large. And we believe returning back to the community is also part of our missions to achieve a better kind of environment. Next, please. Okay, this is basically some TCFD framework that you will be able to take reference to when we actually publish our annual reports. It will address some of the things like heat waves, water level raise, and all those things. This is the basic kind of metrics and assessment. They will look into it, and also how we're going to manage the risk profile and the likelihood of this kind of climate impacts going to take place and all those things. Next, please. So I think in general, what I'm trying to say is that we'll continue to focus on our investment and acquisitions strategies, and of course, having the asset brought into the portfolio, we'll continue to proactive manage it with asset management, and also see how we can enhance and also produce more values to the asset, and then in the case increase the returns to the unit holders. And all this will also done through a smart kind of capital management to make sure that we have more creative capital structures to manage our borrowing in order for us to increase the return to the unit holders. And with that, we managed to increase our market caps to 1.8 billion and deposited property of 3.7 billion, and we still continue to achieve a very high distribution yield of 6.1%. And with the acquisition of GEM, our net lettable area increased to 2.2 million square feet. So our key focus for the coming year will be continue to drive resilience and sustainable returns to the unit holders. And we will actively manage our capital management, and also proactively manage our asset. At the same time, look for yield accretive acquisitions and see any things that we can do on the asset enhancement to improve on the distributions. And nevertheless, looking at technologies that we can leverage on to improve our reach to the tenants, to the customers, and also to any kind of potential opportunities that we have. Next, please. I think with that, I have concluded my presentations. I pass it on to Benjamin to sort of manage the stage. Thanks.
Thank you, Mr. Chow. May I now invite Mr. Benjamin Goh, Head of Research and Investor Education, to moderate the Q&A session. Participant, you may input your questions in the Q&A session here. And for our Facebook audience, please click on the link in the description box to join. We'll try to answer as many questions as possible. Over to you, Benjamin.
Well, thank you very much, Eileen. So we're very warm welcome to Kelvin. Thank you very much for joining us. Always very appreciated for a REIT operator to meet our retail investors. As you already know, retail investors are quite on about REITs as a dividend play, right? And of course, your marquee trophy property 313 Somerset I mean, I remember that's the one with the Hai Di Lao, right, on the third or fourth floor, right?
Yes, that's right. Fourth floor.
Yeah, spend much time there at Hai Di Lao. Okay, we do have a couple of questions pre-submitted as well as 3 that have just come in through the Zoom Q&A. So I'm just gonna go through some of these with you, and
Sure.
hopefully you can shed some light. Okay, so the first question is really about the sponsor and what kind of new assets do you see being injected into Lendlease REIT? So 2 of them that came out in the question would be Parkway as well as PLQ, Paya Lebar Quarter, I believe. Do you see those being injected into the Lendlease REIT?
Yeah, I think it's a very smart question, and I would just share with you on the sponsor perspective. I think for a sponsor, basically this will be the one and only REIT that they're focusing on commercial asset. I mean, for those that actually don't know about it. So in the case we will be the happy recipient of all the commercial asset that is within their management or within their development or even within their controls. Or even not within the control, within the management, I think we are able to access to it. So if you look at the magnitude, it's about 100 billion kind of size that we are talking about. So of course, we are not going to say that we are going to grow immediately to that size, but we certainly be able to sort of access to these assets and see whether is it relevant to the REIT. And then if not, we will just pass and then they will do some kind of open market sales and all those things. So we certainly be able to do that, and that means we can actually grow our footprint globally. But at this moment, I'm more interested to grow my presence in Singapore. So if you after the GEM acquisitions, you will realize that our exposure in Singapore could probably become 88% or so. So I think that's when unit holders and also some institutional investors find that they appreciate that kind of thought and also the kind of things that we do to make sure that we buy asset that actually is very relevant for them, that they can assess, they can feel, and they can then believe, and then they can invest, and then they can always know and be able to look at, to observe the asset performance and all those things. I think that is what we're trying to do. So in that case, then you bring back to the 2 assets, whether Parkway or PLQ and all those things. I think both assets are possible. Of course, both assets has their merit. And for those that actually stay in the East, they know that Parkway is very iconic. And it has been there for a while. I think a lot of older memories and a lot of people that like to go there because they just like the environments over there. And PLQ is pretty new, I think, and also is also able to attract a lot of people going to the place because it's near to train stations and it's very convenient for people to meet up and all those things. So these 2 assets, it could be our pipeline, but it might also be something that we need to plan forward to see whether it meet our objective. Because we do actually state 4 criteria in our prospectus. I think if we want to acquire asset, I think firstly he has to be at least 80% 80% occupied. And secondly, it has to have no major AEI for the next 2 years. And I think thirdly, it has to be, I think the market rate is receptive. I think fourth is to make sure that the asset is able to generate a market rate that actually be able to give us the kind of returns. So these 4 criteria always stay in our mind. So that in that case, we need to then, when we look at these 2 assets, we need to assess whether they met this criteria. But as far as you know, I mean, Parkway Parade actually is still undergoing some MRT construction and all those things, and it will probably complete by 2023 or somehow later. So that's what we think, that if let's say take that into consideration, it might not be Parkway Parade on the immediate pipeline, but if let's say given the 2 choices, it could be, if let's say it's only the 2 things that we can buy, then I say PLQ might be our better pick comparatively.
Okay, I mean, certainly it's very exciting to see Lendlease, become the owner of this kind of iconic properties. I mean, speaking of which, Parkway Parade. I mean, I grew up with Parkway Parade. I used to live in Marine Parade. That was like the only major shopping center. And this was 30 years ago, right?
Yes,
so
yes.
yeah, so that was a time when MPH had a ground floor, and then there was Toys R Us in the next building.
Yeah.
Those were the good old days.
Yes.
So yeah, so I'm rooting for Public Parade, but obviously, whatever. And to be quite honest, the first time I went to Jam Shopping Center, that was a couple of years ago. I mean, long before COVID. I would say it was on a weekday afternoon. I was actually quite shocked that there was a lot of foot traffic. And what I told my team back in the bank, right, is like, hey, quickly go and find out who is the owner for Jam. I mean, we're talking about Wednesday afternoon or Thursday afternoon. So much foot traffic. I mean, this is kind of like a fine, it's like quite rare because you kind of expect this to be somewhere in Orchard Road or Raffles Shopping Center. This is Jam at Jurong. I mean, I hardly go Jurong. I just step in for fun. Hey, what's this? Yeah. So I mean, those couple of good picks, obviously, and 313. So I would say that the retail investors are generally quite happy with the portfolio. I mean, speaking for myself, but I mean, I've been to the shopping centers. And the question is, just now you mentioned expansion in Singapore, right? There is a specific question about the land that's beside 313. I think it used to be an open car park and there was a post office or something there. Is that the one that we're talking about? And do you have any plans for developing that?
I think that car park, of course, we want to bid and we are, of course, interested to develop it. At this moment, we are working up how we can best unlock the values. And with that, then we certainly be able to deliver a very accretive yield to the investors. At this moment, we still believe that that place is going to be developed and it's going to develop soon. Of course, it actually sort of hold back because of the COVID and also hold back because of some administrative matters that we're going to iron out. But at the end of the day, we work out the numbers, it's still going to be accretive. And we are working out with, we try to actually come up with better plans to actually reduce our some of our capex exposure while actually achieve the current returns. So we are working on that. So not to worry, it's not that we are not doing anything. Well, the land seems to be pretty bare over there and we hold it up. It's because we want to come with something that is more appealing to the neighborhood, because we believe we have a strong presence in Somerset areas, and we continue, and we have a vested interest to sort of make it as interesting as possible, so that in that case to make Somerset an interesting place that people will come to. So we certainly are working on that. And certainly we didn't forget about the site because it's just next to 313. It's just a matter of how we can think of a better way to unlock more values to unit holders. At this moment, I would say that the plan that we have in mind can unlock even more value to the unit holders. So in that case, that is what we are looking at. So please give us some time. We just wanted to have the plan more polished to make sure that it roll out something successfully. I think all the agency will like it. When I say agency, is basically in the light of URA, STB, and also SLA. They will. I mean, we want to come out something that they like it. At the same time, achieve some of the criteria that we do that make us to win the site. I mean, during that earlier. So not to worry. It's not something that we've forgotten. It's just something that we try to polish it to make sure that it come out to be a better returns compared to what we have initially announced to the unit holders.
Okay, I mean, certainly I'm looking forward to it because the where 313 is kind of like the tail end of Orchard, right? Before you get to the Istana, right? And then opposite there's the cold storage, and then the old shopping center next to it. Just talking out my head, you should just buy those two pieces. I mean, really, those. The shopping center used to be great 30 years ago. Have
you checked out the owners?
Yeah, Center Point kids, right? But it's like nowadays it's not exciting. Just and really 313 is very well done. Seriously, the layout and all that. All right, so we'll be very excited to kind of see what's coming out next from Lendlease for that piece of property.
Sure.
Now moving back to the financials. In your slide, you did show a. Was it a weighted average of your cost of funding was what 1.69%? Yes. And just to clarify, that has been a hedge. So about what 60-ish% is hedged to fixed rates, right?
Yes, right.
Okay, that's actually quite a good number, 1.69%. Sure. And that's hedged for the next until 2026 or something.
Yeah, 2.8 years.
All right, 2.8 years. All right, so so just to kind of round it up, there's a question here about that. Since not all of us know what the actual hedge weighted average cost of debt that that Lendlease is carrying, how big of an effect is this rising interest rates going to have on Lendlease? But of course, with the backdrop that most of it is already hedged at 1.69%.
Yeah, I think for some sensitivities that we are trying to run, if let's say there's a 50 basis point increase of the interest rate, we are looking at around 2.5-ish percentage of impact. I think it's relatively manageable for us, given that, as you rightly pointed out, our interest rate is still at as low as 1.69. I think that impact, I think, is relatively low compared to our peers. And also, if you look at our profile of the asset, I think we believe this asset will continue to be able to generate very good cash flow. So while we are managing the interest rate in isolation, I think we believe that the profile of the asset will continue to generate and increase the cash flow distributions. And I don't know whether the audience know that on our list we do actually have an inbuilt kind of rental escalations on a year-on-year basis, and I think most of the leases, around 80% excluding those offices that we actually lease to the Ministry of National Development and all those things, it's about 80% of our lease has this annual rental escalation. Is approximately 3% something. So we believe that even if we do nothing, and even if we go to renew our lease expiry leases to the current rental that we have, that kind of natural rental escalation will improve our distributions. Not saying about anything else that we do. We try not to manage the interest rate, but I think with that kind of higher kind of top line numbers, I think it make the bottom line more manageable from that perspective. Although 60% kind of hedging, I think is also relatively I think high to us, and to us, we feel that we have to actually have some certain kind of flexibilities in order for us to deal with any kind of change of interest rate trend and all those things. And we might actually also use the opportunity to redeploy some of our loans or borrowings to other kind of mechanisms to sort of manage the whole capital profile and all those things. So it's all because we want the flexibility, so that in that case we don't want to overhedge. So that in the case we lose the flexibility. At the same time, we believe that our interest rate is low, and also our interest coverage is also relatively high. I think if you talk about 9.2 times kind of interest coverage ratio, I think if you look across the peers, I think probably I think we are one of the highest. So we still are able to actually take the kind of wait and see kind of sort of attitude while we see how we can sort of deploy our interest positions going forward. But I think 60% hedge is relatively manageable and relatively reasonable for us.
Okay, sounds good. There is a related question here about interest rates rising by 1%, 100 basis points. So if that's the case, if let's say your cost of debt increases by 100 basis points, 1%, how is that going to affect your DPU? Is that going to be going to be significantly negative?
It's about, yeah, if let's say 1% is about 5% impact. Yeah, I think that's why I say just now 50 basis point about 2.5. I think 1% is about 5%.
Okay, so that's kind of the rule of thumb. Actually, that's quite helpful.
Yeah.
So, for the retail investors,
yes,
having this kind of rule of thumb is quite helpful.
Sure. Right.
All right, good. So there is a specific question, because on one of your slides, you're talking about the perpetual, what do you call securities? Yeah.
Yes.
Is that already factored into your gearing ratio of 40%?
Perpetual is not. It's actually equity. Is traded as equity because
preferred stock, right?
Yeah, it's a preferred stock, and that of course is depend on the issuer, which is us, to see whether we want to sort of repay or we just continue with the perpetual when it comes to when it comes to the due term. So in that case, perpetual is not a debt itself. So it's not actually part of the 40%. I think that is standard across the market anyway.
Yeah, it is. I mean, from a financial analysis perspective. So the question here is, I guess, if it was included in the 40% gearing ratio, is that going to be a material impact?
I don't think it will. If I were to do a quick number, let me see. No, yeah. I think it will be around 45% or so. I think it's still relatively good, but I think not to worry about that. I think it's just another alternative debt instrument that we sort of deployed to sort of manage our gearing ratio, at the same time to manage how we can provide different kind of variable funding instruments to the whole structure. At the end of the day, as long as the performance of the asset is still the asset is still able to deliver a performance and all those things, I think that is something is well manageable. And in fact, if you look at the circular that we have, when we talk about the GEM acquisitions and the projected numbers, and you compare to what we have announced and the actual result, you should be able to aware that we are already outperform what we actually put on the circulars. And all this is because, I mean, we use different type of instrument. At the same time, we also be able to lower down our interest rate and improve on the performance of the asset. If you look at it, let's say perpetual is treated as equity, and our current equity yield is actually 6.1%, but we pay a 5% of perpetual interest. I think from that arbitrage, you actually still have a gain of 1%, which that is actually distributable to the unit holders. If let's say instead of raising perpetual, we raise equity, then it will be a different kind of scenario. And not forgetting, perpetual is something that as an issuer we can sort of redeem it, and that means there will not cause a perpetual dilutions as equity as it replaced with equity raising instead of a perpetual. So it's an in-between debt and equity kind of instrument, but it do actually provide us the flexibility to bridge through the funding requirement for that moment. But as we pass through this moment, and we can do something else with the current positioning, and we can actually do so and then improve the return of the unit holder. So I will advise the unit holder not to worry too much about perpetual. Why is it not there and why is it not that? And I think the more important thing is that whether the underlying performer or the underlying portfolio is able to perform. If they're able to perform and you're able to fulfill all its interest, covenants, and all those things, I think you just need to trust the management that it will able to continue to deliver returns and able to manage the whole capital structures to provide the best return to the unit holders. I think that is something that probably I want to share with the unit holders here.
Okay. I mean, certainly having the preferred stock is on the weighted average perspective lowers the cost of equity.
Yeah.
Right, since your dividend yield is already 6+%. Okay. All right. So let's move on to a different topic. So there were a whole bunch of questions about the retail industry. So given global recessionary fears, exiting from COVID, so on and so forth, and a substantial proportion of your portfolio is basically based in retail. So what are the challenges of onboarding new tenants, and what are the plans ahead to grow this part of the business?
In fact, we have a lot of happy problems so far after we sort of move out of the COVID when the border opened up. And there's a lot more tenants looking for space, and that's where we can actually command a higher rental, and also to be more selective on the tenants that we want to put into the mall. I think that is definitely true for 313. Although we always maintain a very high type occupancy, but I think now the choices of the tenants is even wider. As for GEM, it's always been well sorted for. I think a lot of tenants has been queuing up to actually take up some space. So GEM actually at certain point of time is even 100% lease and all those things. So sometimes the lower occupancy is due to some transition period and all those things. So, and GEM is actually very focused on this essential service. So that in that case, it provide a very strong layer of stabilized cash flow. I think their essential service is about 57%. So it provides the kind of stabilities on the mall itself. At the same time, GEM is an integrated development. He has the office, and the office is leased to Ministry of National Development. Again, it's very stabilized cash flow. And that's mean the free space that they have available for this is really probably net of the essential service, which is very sticky to the mall itself. It's only around 43%. So with that, and you have the IKEA of that and all those things. So again, it left a little available space for the movement of tenants and all those things. So we always been very selective to put in the right tenants because we want the mall to be continue to be having a strong footfall, the sales continue to outperform and all those things. So I think with that, I think we are not worried about the portfolio and also not worried about the retail scenes. I mean, there are of course concern about recessions and all those things. I think to us, as long as he has a very strong stabilized kind of cash flow anchored with very essential services and also anchored with some kind of stabilized tenant space, I think we are good and we're supposed to be able to manage through the period. I mean, look at it. I mean, during the COVID, everyone is worried about how we're going to manage the mall and all those things, but we continue to deliver very good DPU returns. That's why just now there's a slide that I show about the DPU return. We moved from 3.05 to 4.65. That is during the COVID period. And at this new year, we are about 4.85 cents. So, I mean, there are ways to manage it. Of course, I mean, the fears and the threat is always there. If you are able to manage it and you're able to dissect the problems and able to conquer the problems, I think systematically, I think we will continue to be able to deliver results. I think most importantly, have to have the confidence on the portfolios. And so far, we have very strong confidence on our portfolio because of the GEM, which is very iconic to the west of Singapore. I think 313 continue to have a strong influence on the Somerset Precinct, able to attract his targeted customers to the mall. And then the Milan asset, I mean, is anchored and with Sky Italia, I think that one continue to give us very stabilized cash flow. So we are not worried about that. Sure.
Okay, thank you very much for that. Actually, when you're talking about the DPU, I'm actually just staring at the slide. That was something that I was actually quite excited about. Yeah. So, okay. All right. Next question. So we talked about the tenants mix as well as the retail sector. So adding on to that, there was a specific question about the tenant retention by, I guess, net leasable area of 59%. Is that considered good? Quote unquote, that was a question.
I think it's a good question. If let's say that tenant retention is pertaining to industrial properties or pertaining to offices, I would say probably is not a good percentage. But if it's pertaining to retail, I think it's a good percentage because I think for retails, you always have to refresh your mall. You always have to bring in something new that attract people to come to the mall, especially for 313. You will always have to maybe obsolete those that actually cannot perform well and then bring in the new ones so that people will come to the mall and have fresh offerings and services available. I think so that's why we always want the retail list to be shorter so that we can sort of like monitor the performance and then sort of phase out some of these tenants and bring in the real tenant. So that is actually quite I would say quite something that you can monitor, but don't take it too seriously for retail mall, because you have to look at it in tandem with your occupancy rate. If you have a low retain rate, but your occupancy rate is also low, then you are worried because people are going out without replacement, right? But you have a low retention rate, but a relatively high or rather high occupancy rate. That is something that it could be the management that try to replace some of these tenants to continue to make it more relevant to their target customer and all those things. So for us, I think that is something that we will monitor. It's not something that we will be very concerned about, but I think we rather want to change and bring the right tenants and reduce. To reduce the retention rate in order for us to continue to have a very good occupancy and generate very good footfall and all those things. That's our main objective. So when you look at retail asset, look at these two things in tandem. Don't look at just retention rate. But if you talk about industrial property or something, other properties that actually have a longer lease, then I think the retention rate probably make it relevant. But retail asset probably is less relevant. But have to read in tandem with something to make sure that you have the full picture of what we are trying to do.
Actually, paradoxically, that makes a lot of sense because if you look at again, just not to talk crap about Centrepoint, but really it's quite boring, right? And generally it's the kind of the same thing. You've got the furniture at the top floor, then you've got the camera shop, it's about there. Or you look at Lucky Plaza. So in that sense, yes. Yeah, so I guess you know, when it comes to retail mall, you do want to refresh your tenants once in a while. Okay. There has been a bunch of questions. Okay, so why did Lendlease bar out of the Mercato portfolio bid?
Actually, it's depending whether the parent were to try to bid for the tender, or whether we as a REIT we want to bid for the tender. But the portfolio is relatively big, so I think it doesn't make sense for us to actually go ahead with it, given that it means another kind of uncertainty in terms of fundraising, also in terms of portfolio enrichment and all those things. So we rather actually stay out of it. But I think the parents probably will take the actions and then see how they can sort of position themselves with the portfolio, and then eventually see how it makes sense to the REIT. So we bring in another layer, so that in that case, to sort of like filter up all those good ones, because the portfolio itself is also a mixed bag. I would say that it is a mix of good and bad. So in the case, we want rather the parents take the ownership to sort of filter it up, and we take it and we can't chew it, and then we have to throw it out. And then that kind of things, again, first of all, it means you need to raise the fund, but actually, in that case, after that, you throw it out of the portfolio, and then what do you do with the extra fund, all those things. So that's not something that we want to do. Although also the size really matters. I mean, if you have a bigger size, you are a giant kind of REIT, then probably that kind of acquisitions size will be something that is also chewable for you. But for us, I think we also want to look at it relatively to our size, and also how it makes sense to us. And that's why we think that if let's say you want to participate, we will let the parents participate and see. Then in that case, once the parent really, if let's say they really win the site, then we will win the portfolio, then we will then decide what is good for the REIT and what is something that they can actually so throw it up to the market. So for us, we do want to be the direct, we do want to go directly to the portfolio itself.
Okay, that makes sense. And certainly this is the governance framework at work, right? So it doesn't mean that the parent don't want to do, then the REIT will simply go along, right? So there is another layer of deliberation and consideration.
Exactly, that's good, because you have a parents, they look after you. I mean, that's the whole reason why parents means a lot to us.
Yeah, okay. Until you hit 18, then you become a Centrepoint kid. Okay, anyway. I mean, aside from the Centrepoint jokes. Okay, so there was a question here about the Lendlease has entered an agreement with Singtel to redevelop the Com Center, yeah, the big building near 313. So would you be able to shed light on that? You know, how does that fit into your plan for total world domination? You got 313, then next to it you've got the open space, and then now you got Com Center. In the future, the whole part will be Lendlease lah.
I cannot speak on behalf of the parents. Of course, parent has their own plan, but we certainly look forward to the opportunities that we can acquire the stake that they have. If let's say there's a big available, I mean, if I cannot speak on behalf of the parents, and also I have to be very sensitive to what Singtel want to position themselves, to be honest. But in any case, be that is actually in the REIT or managed by Lendlease, I think we certainly have a very strong presence at that area. I mean, of course, it will be good that the REIT can actually buy over the stake, but that will be something 4 years later, because the whole thing need to the building need to be vacated, and then after that they do the demolishment, and then they do the construction. So it take a while. I think we hope that we can actually acquire the asset for sure. But in any case, if let's say any change of plan or any things that is make it different, we still are present there. I mean, we still have a strong presence there, be it from the Lendlease parents and being for us. I think there will certainly be some coordinations and collaborations among us to sort of make that place the pristine, very vibrant, and also create a lot of cross marketing and strategies around it. But nevertheless, I think we do actually involve in other kind of development, and Lendlease has a stake into it in Singapore. So all this will be a pipeline to Singapore, to us. I mean, everyone, as you rightly pointed out earlier, is that only thing that we have Parkway Parade and PLQ. In fact, we have more kind of other collaboration with others owners, and we take very high investment to that also, and that could probably help us to build our Singapore presence. If I add all this Singapore pipeline to the sum of our portfolios, right, it could probably make us close to 10 billion or so. So in that case, so you can believe that if let's say we want to continue to be very Singapore centric, I think we can do so. But of course, never miss opportunities that is overseas. Like for example, someone was questioning us, hey, why you want to buy the 3 Milan asset? But do you know that this 3 Milan asset has been, I mean, during the COVID period, has been the one that actually continue to give us very stabilized cash flow for distributions, and we continue to have the rental escalation, and the recent escalation is around 4.3 or 4.35%. And look at it, I don't think Singapore has that kind of escalation on rental. And this is not forgetting, this is a triple net kind of lease arrangement. That's mean even how worrisome you have on the utility costs and all those things, this is actually paid by the the tenants. We just need to get the kind of regular kind of rental payment from them as well.
Well, I mean, certainly again, as we have spoken about just now, the portfolio that Lendlease has quite recognizable names, especially on the Singapore side of things. So, you know, we'll be excited to hear what happens in the next 4 years with the Com Center building, right? And we're running a bit out of time, but we've got a couple more questions I thought were a bit interesting. So there's a question here about future funding sources, right? So would you be able to add some guidance about the possibility of doing a rights issue for Lendlease?
I think it's only if we need to acquire a very huge size of asset, then we will trigger right issues. To be honest, if not, I think we look at whether maybe a reasonable mid-size kind of fundraising through private placement or even preferential share offering. I don't know preferential share offering you consider as a right issue, but it's more to us. It's just it's a shorter period of time that we need to sort of like exercise the whole process and kind of thing. So I think for us, really the shorter period of exercising the whole process, I think probably preferential offerings and private placement is something that is more relevant for us compared to kind of right issues to the market. But of course, all depend on the size of the acquisitions you are talking about. But you know that for office and retail, more is never cheap. So you will always certainly go for some equity fundraising if you really have something that you're looking after and want to acquire and build into the portfolio. So it's never cheap, but we want to actually, if let's say we need to do the acquisitions, we would like to exercise. We like to exercise as soon as possible. So in that case, the outright right issue to public is not really something of our preference. But I think we will prefer something like a private placement or even preferential offering the most. I think that's what we're going to adopt.
Okay, I guess the motivation for this question is that it's, you know, from a retail perspective, it's sometimes a bit annoying in the sense that, you know, if the stock has got a rights issue, then if you don't sign up for it, then there'll be a dilution. I mean, certainly that wouldn't be a problem with the preferred stock, because preferred stock do not have any, they cannot go to the AGM and all that, right? So it's
Yes.
yeah, so that's a slightly different thing. All right, okay, good. So there was one question about the net triple lease. So you mentioned that the Milan property is based on a net triple lease basis, right? What about the Singapore side of things?
Singapore, technically, I would say it's about double net, but we still take care of the, I think, insurance and all those things. Yeah, if I'm wrong, it's double net. Yeah.
Right. Okay. Okay. So that means the current cost of utilities escalating and all that is not really an issue for the REIT operator. Yeah. It's more like for the tenant, right?
Yes. Yes.
Okay. So if I go down to Gem and I see some shops without switching on the lights, I know why lah, because they're trying to save a utility. I'm just kidding. All right. I think I'll just take one or two more questions since we're already about over time.
Yeah.
Let me see. Yeah. So with regard to global REITs, so we talked about the retail space. So with regards to global REITs in general, like Lendlease, what would worry you most?
I think for let's say you look at our portfolio, I think majority is the retail asset. So retail asset is the most complicated, I would say the most complicated asset compared to other kind of asset you're talking about, because you are not only concerned about bringing the right tenant, you're also concerned about whether you can bring the customer to the tenants that make their business viable. I think that's when you need to actually make sure that you provide the right environment for the operation, provide the connectivity in terms of marketing, promotions, for them to reach out to the customers, and also ease of reaching out to the customers. And also at times you have to provide the technologies to sort of like make the place more conducive. In that case, to bring down the service charge so that in that case they can operate at a lower cost and all those things. So all is slightly more complex. Of course, each asset has its different kind of complexity, but for us is a tripartite kind of arrangement which we work on different kind of consideration, be it the customer and the tenants and all those things. So I think the things that will make me concerned is whether we bring in the right tenants to the mall, because once you bring in a tenant, it actually lasts for 3 years. And that's when I actually very concerned about bringing the right tenant mix and all those things, and continue to change the tenant mix to make it very viable for our appeals target audience and target customers and all those things. And also, of course, how to make ourselves relevant is something that make me worried and concerned every now and then. So I will always go down to the mall and supervise and look at what is the people looking for, which are the one that actually more frequently visited by people, and why is it that some of it is not visited by others and all those things. So that is something that made me concerned. Yeah, I mean, maybe probably other peers might feel that the interest rate will be something that of their concern. For me, technically our interest rate is relatively low, and I'm actually trying to position it at 60%, so that in that case we provide the flexibilities, and also we have a high interest coverage ratio. So to me, not seriously a concern. Also, I think to some peers, they might feel that utility cost is a concern, but to us, I think fortunately we have locked in the contract for another year. That's been the whole financial year, and by I think next second half of next year. So in that case, it's totally locked in with a very good discount. So in that case, I think if let's say it get worse, I think the peers will suffer more than us for sure, because we lock in a very good discount. So that one again is not a concern. And also because we embark into this sustainability initiative and net zero initiative, we really sort of like reduce some of this energy consumption as much as we can, so that we can achieve our net zero carbon target by 2025. So all this seems to be actually benefiting the REIT and benefiting properties compared to other peers that still probably are working through the system to actually get to meet their net zero carbon target. And so with that, I think we sort of like manage it very well. So those popular questions regarding to interest rate and utilities, I think that is something that we concern, but not as much concern to the others. But we rather look at the top line and see how we can continue to manage the top line. Because if the top line is sustainable and strong, I think the bottom line is something that you just need to continue to maintain it or even reduce it with different kind of technologies, replacement and all those things. I mean, that's the whole game plan that I'm looking at to manage the REITs.
I mean, certainly it's quite exciting, Lendlease, because of, again, the iconic properties that you have and the fact that you've already locked in your cost of debt about 1.69% until 2026. So, yeah, so the risk factor for, in terms of higher interest rates is not going to be that great for Lendlease. So that's very reassuring. Okay, so Kelvin, thank you very much for speaking to us this evening. It does show my age as well as yours that we can joke about Center Point.
I'm a 313 kids.
You're 313 kid. Oh, you got such a term. Okay, I need to learn. I've not been to Heidi Lau for some time because of COVID, but yeah. So thank you very much for joining us this evening.
So much,
very wonderful discussion. Jokes aside, and we've unfortunately ran out of time, but we really do hope to hear from Lendlease, once every few quarters, just to kind of get updated on what's happening with the Somerset Road and Com Center and all that, because it looks as though it's very bright and interesting news that we'll be expecting in the next few years.
Sure.
So thank you very much for joining us this evening. Very appreciative of that.
Thank you, Ben, and thank you, Eileen.
Thank you. Yeah.
Okay.
Thank you, panelists, for the insightful sharing. We have come to the end of this session, and for everyone to join us this evening. In case you missed any part of today's session, you can rewatch the webinar on SIAS YouTube channel. Do visit our SIAS website to get updates on upcoming investor education programs and initiatives. With this, I will end today's session. Thank you and have a good evening. Bye, everyone.
Thank you. Thanks, Kelvin.
Thank you. Bye.